So the subject I wanted to talk about today is I labeled this one Volatility ETP Termination. And I just want to make clear that while I am going to be talking about what causes the termination of these volatility products, what has happened in the past, how likely it is to happen in the future, I do want to make sure that everybody understands that I'm not just talking about whether you buy the ETPs or not. This applies to options trading just as much, if not more, than the actual ETPs. Because options, especially if you're doing shorter dated contracts, they can move even faster than the underlying ETPs. So just because that's the backdrop and that's the subject, don't think that you're safe just because you trade options. So in fact, like I said, it might even apply more if you're an options trader. So the first thing is, whenever we think of termination, of course, we think of the XIV. All right, people probably remember that old XIV. It was a 1x inverse product of the SPVX STR index. And it terminated on the Volpocalypse event, as we call it. Volmageddon, insert your natural disaster, add vol in front of it. You've probably heard it referred to like that. So, Volnado, I don't know, hurricane, Volmacane, whatever it is. People often use natural disaster with vol, but I like Volpocalypse. So February 5th, 2018, we actually lost the XIV. And when it happened, of course, it was shocking. People didn't realize that that could even happen. And when it did, even those of us who knew that it could and probably would at some point, even I knew it was going to happen, but I was still surprised when it did. So I put out a little warning, well, not a little, several warnings. I wrote several articles and did several videos talking about how these products would eventually cause some issues for people who don't understand them. So I just wanted to play that old video, just a little segment of it. Again, kind of a test, but also there's a little bit of a lesson in there. So I'm going to play this. Apologies for the sound quality. It's my actual file for the video is on a hard drive that I have back in Taiwan. So I just had to record it straight from the computer. But let's play this little 1-minute clip.
However, the XIV has one potential downside that needs to be addressed. In the prospectus for the product, there's what's called an acceleration clause, and essentially what it says is, if there's a market event that drops the price of XIV over 80% in a single trading day, the product can be terminated. Now the question becomes, how much of a concern is this really? Is it possible for these products to lose 80 to 100% in a single day? The short answer is yes. Now, in a practical sense, the odds are pretty low, but it does need to be said that this is technically a possibility. And if you view it through the lens of quantum mechanics and Murphy's Law, one might be inclined to say that on a long enough time horizon, it's not only possible, but likely. The Black Monday crash of 1987 would easily have done it. So whether an event like that can happen again in the future is up for debate. But the way I look at it is, acknowledging that volatility products can go to zero in a single day is valuable. It makes the trader put risk management at the forefront of their strategy building. It means that no matter how badly we want to get aggressive and shoot for huge profits, as responsible traders, we just can't. Nobody knows if and when this type of event will occur. So really the only line of defense is making sure that we're only allocated to trades during the most ideal times and making sure we're in cash for all of the rest.
All right, so again, hopefully you heard that video. Kind of learning my software here, how to include little clips here and there. But that video from 2017, early on in 2017, from that guy who, used to still put on a shirt and tie for these types of things, he's absolutely right. No one knows when and if these events will occur. So obviously we want to be fully prepared for when they happen. And later on, after I go through a little bit of the statistics surrounding that Volpocalypse, I'm going to give a little quick breakdown of some things that you can look out for that will definitely make your trading safer, that might be able to get you on the sidelines or perhaps not as allocated when one of those terrible events happens. Because honestly, it's probably going to happen again. I think it's always a good idea for people to just assume the worst and not at some distant point in the future. Look at your portfolio right now today and assume that there's going to be a flash crash tomorrow. How prepared are you for that event? If there was a flash crash tomorrow, what would your portfolio look like? That's the mindset that you want to go into these things, because volatility trading, I don't care how good you are at it, how well you manage risk, how much you think you know about the market, it does have a way of surprising even our worst expectations. It is riskier than regular investing. So I'll get into a checklist later on. But the first thing that I wanted to show you, of course, after I gave that warning, within a year of giving those warnings, we know here's what happened. So I'll make sure I do screen share. I had that malfunction last time. This is what happened to the XIV on Volpocalypse, right? This right here, this disastrous collapse. So this is showing the XIV from simulated prices going back to March 26, 2004. And you can see it started out at $1.28 and it made its way all the way up to $108. Now, these are large crashes as well. This is a 75% crash. There's been many 75%, several 75 or 60% crashes along the way. So it's not like it was totally safe, and there were red flags all along. But this last one, this last kill shot, from $108 to $4 in a single day, right? Down 96% of its value. So obviously that's pretty diabolical results. Now, what we need to know is that's not, let me pull up that again. This crash is not because of supply and demand. It's not because, actually I should be going on full screen. Sorry, bouncing around. It's really important to understand that that's not because a whole bunch of people got scared and started selling the XIV, and that selling caused the XIV to go down. Remember, supply and demand is not the operative thing here. These ETPs function entirely on a methodology of tracking what they have, a 30-day constant rolling contract. Now, if you want to know more about that, I have a video on my YouTube channel very recently. I think it was called something like "Don't Buy VXX, the roll yield crushes it," something like that. That'll explain that whole thing. But essentially what I'm talking about is this index right here. This is the SPVIX STR index. And this is essentially identical to the 1x long VXX product. And that XIV that crashed that day, the XIV that crashed 96% in a single day, is based on this index. So if we just go to 3 years, and we can include that Volpocalypse spike, you can see over here, on February 2nd, it was at 56.28. And on February 5th, it was at 110.37. So if we just do a quick calculation here, 110.37 minus 56.28, and then going from a starting point of 56.28, we've got a one-day spike on the SPVIX STR index of 96.1%. So that's why, when we look at the actual XIV, that's why we see it down 96.1%. On that day, it is an inverse on a one-day basis of the SPVIX STR index. So that's really important to understand that this had nothing to do with supply and demand and a bunch of people getting scared and selling the XIV. That's not why it crashed. SVXY, the same thing. It's basically a mirror product. It uses the exact same methodology. It also crashed 96% that day. But again, it's based on this underlying index. Okay, so that's obviously a very important fundamental thing to understand about volatility products, is that it is always based on this index. So UVXY is 1.5 times this index. The old TVIX that was delisted, 2 times this. The new SVXY at its deleveraged level of 0.5 times. It is a 0.5 times leverage inverse one day of this index. Everything is based on this. Okay, so that's why the XIV crashed 96%, because the underlying index and its methodology did as well. So when we talk about the largest spikes in the past, October 1987 has to come to mind, right? So what we're going to look at here, this is a chart comparing what's called the VXO to the VIX index. Now, hopefully most people in the comments, you know what the VIX is. It's a calculation of S&P 500 options, right? It's measuring forward implied volatility. The VXO is essentially the old VIX. It was using the S&P 100, not the S&P 500. And the VIX index can be calculated back to 1990, but the VXO can actually be calculated a little further back. So while we can't see exactly what the actual current VIX was doing in 1987, we can see what the VXO was doing 1987. So this here is the old VXO measuring based off of the S&P 100. This is essentially the old VIX through 1987, start to finish. So you can see that it was slightly higher volatility during that time period. Sorry, I've made this mistake before, just checking if it's screen share. All right, looks good. So you can see that the VXO was a little bit elevated throughout the year, right? It looked like bouncing around between about 18 and maybe 30. And right before, on October 16th, it closed at 36. And then on Black Monday, right, the following Monday, October 19th, that infamous day, it closed at 150.19. So that's a one-day VXO spike, essentially a VIX spike. The VXO tends to under-capture a little bit, but it's very, very close to the current VIX. So it could have spiked as much as 312%. And on an intraday basis, you can see 172.79. So the VIX intraday may have spiked 375%. Now, obviously, that's going to cause major problems to the market, not only for people who are buying stocks, but if volatility products existed back then, obviously that would have been a major problem for anybody who was holding volatility ETPs. As we can see in this chart, nothing even close to that has happened since then. The largest VIX spike being 115% in a single day. That was on Volpocalypse that day. And this sort of moderate volatility spike compared to the old VXO in October 87, this actually terminated the XIV. So it's just good to know that historically speaking, when you're talking about the VIX index, when we're talking about volatility data, VIX futures launching in 2004, we don't actually have a lot of data going backwards, right? It might sound like a lot. You know, we've got 15 to 20 years of VIX futures data, since 2004. We can recreate the VIX going to 1990, but that's not actually that much data. So it is important to get a general context of what could happen and what has happened, not just what could, but what has happened already and most certainly could happen again. We had the flash crash in 2010. It was bad, but I could certainly imagine a flash crash happening maybe tomorrow. Not to get too alarmist, but remember, always plan for the worst. Look at your portfolio, and if it happens tomorrow, then make sure you're protected. But I could totally see a flash crash being even worse than the one on May 6, 2010. So, just keep those numbers in mind. Now, one thing that I wanted to talk about, let me just check my notes here. Apologies for that. This is what makes live streaming hard, is that I want to make sure I don't actually forget anything. Okay, there we go. I wanted to just explain really quickly. When people eyeball this chart and they think, wow, it spiked 115. Oh, that is a mistake. Screen share. Glad I caught that quickly this time. See, I can learn. When people look at this and they see that the VIX spiked 115.6%, they might be confused as to how that translates to an equivalent move in the XIV, right? The XIV only crashed 96%. And oftentimes people confuse the VIX and the volatility ETPs and the VX30 rolling contract. It's all very confusing. So what I wanted to just demonstrate is how much that SPVIX STR index actually moves compared to the VIX index. So this is on average, we call this beta factor. And what beta is a measure of how much one thing moves in relation to something else. So here we've got the SPVIX STR, that is that index, the underlying index for all of these volatility ETPs. How much does this move in relation to a spike on the VIX? Okay, so this is the beta factor. If we go to the long-term chart, we can see that it's about 0.49. So just for simplicity, we will say that the SPVIX STR index, on average, moves about half as fast as the VIX index. So if the VIX spikes 20%, we can expect the underlying SPVIX STR to spike roughly 10%. Now, this is just a long-term average with quite a bit of variation in between. It can significantly underperform, it can significantly outperform. That's just a long-term average, but it moves about 50%. So when we say that the XIV crashed 96% on this day, one thing I want to mention to people is that that didn't happen throughout the actual trading day, right? Throughout the trading day, I don't know if you were around and watching it happen live, but when the XIV was doing its thing that day, it actually behaved fairly well in regular market hours. It was actually only down about 35% in regular market hours. And if the SPVIX STR index was up 96% and the VIX index was up 115, one could make a case that the XIV should have probably been down about 55% in regular trading hours. That is according to the long-term beta factor. But remember, there's a lot of variation. So the XIV actually performed reasonably well that day during market hours on February 5th. But what ended up happening was in the aftermarket rebalancing, there's a 15-minute period from 4 o'clock to 4:15 where all of those volatility ETPs have to start doing their daily rebalance. And that's when things got really crazy. So XIV did reasonably well. I mean, it wouldn't have been a fun day for anybody holding it. Side note, I wasn't. I was in cash well ahead of time. But if you were holding it, it wasn't that disastrous up until 4 o'clock, down 35% or something. And then because of the liquidity, because of all these volatility ETPs, at the time about 5 billion notional value of volatility ETPs out there, all of them doing their daily rebalance at the end of the day, all of them buying VIX futures, it caused those VIX futures to spike up to insane levels. It's essentially a liquidity crunch. And that's what caused all of these problems in the 15-minute aftermarket, where it went from 35% down, not so bad, down 96%, wake up the next day, and we realize that they're just going to terminate the product. So again, it's very important to understand the beta factors of how these things interact with each other. So if the VIX spikes a certain amount, how much would we expect the VXX to move? How much would we expect the underlying index to move? What does that mean for UVXY? These are all things that you can calculate, right? Of course, for me, I keep very detailed spreadsheets. I've got, these spreadsheets that crash my computer, so I have to divide them up. Like this is VIX source 1, I've got VIX source 2, 3, 4. I've got many, many spreadsheets, but all of the data, these things can be calculated. And it is very important to understand the relationships between these things, between this index and how the other things actually work. Yeah, so talking about going back to the October 1987, I always find it fun to look at it. I don't know if you guys do, but just trying to imagine what would have happened this day. So obviously a spike of 312%, right, close to close. This would certainly have crushed every inverse volatility ETP out there. So XIV, SVXY, even the ZIV might have had major problems. There's a different index for the midterm futures, but it could have been a problem across the board. But the one thing that people don't understand, again, very important to understand the products that you're trading, is that long volatility ETPs can also terminate. This is something that you very rarely hear people say, but it's not just the inverse products that can terminate. TVIX can terminate as well. UVXY at its current leverage factor could potentially terminate. And now that you know what these are based on, remember it is based on an underlying index, what would a termination of a long volatility ETP mean? That would mean that the vol crush on the other side of the spike was also significant enough to crush the long volatility ETP. So you can see here, this is going back to Volpocalypse. It went from 56 to 110. If on the next day or the next couple of days, you get a one-day change that goes from a very high level to a much lower number, and it's significant enough, it could start terminating the long volatility ETPs. So you can see it goes from 110 to something in the 70s. Now that's a big move, but that's not quite big enough to crash it. So the official closing value the next day closed, I believe, at around, if memory serves, 81.66. That's a number that seems to ring a bell, something like that, 81.86. And if it would have gone down to something in the mid-60s, then the TVIX would have crashed. So we could have, during that Volpocalypse situation, we could have had a situation where XIV terminates on the 5th, because, of course, the SPVIX STR index spiked up. And then, if the next day, some type of news comes out, people digest the information, and they realize that it wasn't quite as bad as we thought it was, and you get a major vol crush the next day, that can terminate the long volatility products. And TVIX is 2 times leverage factor of that underlying index. So it only has to go down 50% the next day in order to crash. And I think I have the data on the October 1987 spike. So when it went all the way up there, the very next day in October 20th, it was kind of stable, right? So it went up to 152, and then it was fairly stable. It went to 140. But the day after it went to 140, it actually dropped down to, I don't have that number. Sorry, I'm going to have to go on memory here, so don't fact check me in the next live stream. 71 something. Intraday, something like 71. So about a 50% decline. And remember, at 80%, that acceleration clause can start kicking in. So it doesn't even have to go down 50%. It can go down 40%, and then the issuing bank can start considering that acceleration clause. Of course, they can do that anyway. They can close anything they want. But as far as the prospectus goes, it would have had to do that. And in 1987, that surely would have happened. So not only in 87 would we have lost every single inverse product, but we would have lost TVIX almost for sure. We would have maybe lost UVXY at a 1.5 times leverage factor, because although the close to close value wouldn't have done it, the intraday value probably would have. So we may even have lost that. The only product that would definitely have survived that October 87 crash is the VXX, the 1 times underlying. This SPVIX STR index, why do I keep forgetting to do that? The SPVIX STR index would not have done enough to terminate the VXX. And it wouldn't have been enough to terminate any of the midterm products on the long side either, the VXZ, stuff like that. But probably good information to know, right? Because I always operate on the assumption that anything that has happened in the past could definitely happen again. And if you operate based on that assumption, that means that we are all, as volatility traders, we are all operating in a market that could see another volpocalypse. That could happen. And again, just because you don't trade vol ETPs doesn't mean your option trading is any safer. It applies to all of us. We have to know that these risks are out there, and this has happened before. It's probably a good idea if you're a trader to always assume that what has happened before not only can happen again, but will happen again. So you just want to make sure that your risk management techniques are adequate to protect yourself. So that's the last thing that I want to talk about here, is just a few steps of risk management that are probably just best practices for anybody out there who's trading volatility ETPs. And then after that, I will open it up to questions, and I'll try to catch up on this chat. I can see it going. I can see some questions. But let me just finish off this really quickly. Let's go to the screen share here. Here's some things that I think people should probably keep in mind. So the first one, reduce risk on the underlying you trade. No leverage, no undefined options. So I think this one is obvious. If you are trading volatility ETPs, it's probably a good idea to not trade the leveraged ones. And trust me, you don't need the leveraged ones to make a bunch of money. You can be plenty profitable using VXX and the new 0.5 times SVXY. You can be plenty profitable trading those things. You don't need to go into the UVXY. And certainly if they relaunch a TVIX at some point, you definitely don't need 2 times leverage factor. And then this applies to the options world as well. You really don't need to be trading undefined risk options to make money. You can make just as much of a profit trading defined risk spreads, trading things that are more protected against a spike. You really don't have to take on that risk. I know sometimes it sounds like that's a good idea. Let me go full screen here. But the thing about this is what a lot of people are misunderstanding about the options world is, let's say you're trading a short, a naked call option on the UVXY, right? This is a trade that people ask me about all the time. Is it safe enough? If you go look at the premiums of a naked call on the UVXY, it seems high, right? You're going to be looking at a number that seems like there's some really juicy premium there to sell. And then if you go on the other side and you sell a naked put, for example, the premiums don't seem nearly as attractive. And you look at those two trades and you think, well, clearly I want to be selling the call. I can get 4 times as much premium into my account, right? What you're not factoring in, and this is what a lot of people forget, is the risk. When you sell a naked call on the UVXY, you have to take your position sizing down so far to a point where it's actually safe enough to do that. And that costs you money. And then you have to hedge the position, and that costs you money. And then you have to do other layers of risk management along the way to make sure that that position is safe enough, and that costs money. So the point of volatility trading, in my opinion, the best way to make a profit is to get the most amount of capital allocated in the least amount of risk possible. And that doesn't include undefined risk spreads. It just doesn't. Selling naked straddles on UVXY does not allow you to maximize the amount of money you're putting into the market and minimizing the risk while doing it. Vertical spreads do that, defined risk trades. Selling short puts can do that. Buying long put options in the VXX using the stock replacement method, it can do that. You can allocate very large amounts of capital, and the risk management is largely built into the trade. So it's not a fair comparison to just look in your software and say, well, that premium's really juicy on the naked calls. I'm going to go ahead and do that. You're not factoring in all the layers that you have to drop that down, and it's going to cost you money at every step of the way, and eventually you're going to wind up with a trade that, while it seems like there's a lot of premium there, you're actually going to make less money than if you would have just allocated large amounts of capital into safer strategies. You're going to make more money doing it that way. So a little bit of a side rant there. A lot of people don't understand that it's not about the upfront premium. It's about the long term. And undefined options, again, just make it a hard rule. No undefined options on volatility ETPs, full stop. What if there's a flash crash tomorrow? What if there's another October 1987 next year? If you're just getting in the habit of cycling through these seemingly easy trades, you're just picking up pennies in front of the steamroller, and eventually you're going to pay it all back and then some. So just make some hard rules, no leveraged products, no undefined options. Trust me, you can find plenty of ways to make all the profit you need using much safer strategies. So the second one here in orange, reduce your portfolio allocation to a manageable level. I think this goes without saying. If you had a $100,000 portfolio, for example, you don't want to dedicate all $100,000 to volatility trading. For me personally, my tactical vol strategy, it's only a 20% allocation in that portfolio. The aggressive vol, same thing, only a 20% allocation. If you're extremely safe and you have several layers of risk management on, then perhaps you could open that up a little bit wider of a net. But for most people, obviously I can't give out any personalized investment advice, but for most people that, 10 to 30% range is about where you want to be. Don't go more than that. Always keep your allocation small to volatility trading because it is inherently risky. Anybody who says otherwise, maybe they say they're great at managing risk, they're great at exiting trades before bad things happen. Doesn't matter. It's still inherently risky. Those products move very quickly, and so do options. There is no way to 100% be safe when you're trading them. So number 3, in yellow there, only allocate to the highest quality trades. And of course, cash is your friend. There's absolutely nothing wrong with just sitting on the sidelines. If you have signals or if you have a strategy that's just currently not conducive to the market environment that we're in, there's absolutely nothing wrong with moving to cash, taking some time off. Sometimes the hardest thing to do is to just sit on your hands and do nothing. But quite often that might be the best thing to do, especially with volatility trading. So for me personally, again, don't mean to keep referring to my own strategies, but for the tactical volatility, we are only allocated about 42% of the time, somewhere in there, depending on the market. And the rest of the time, we're just in cash. The aggressive vol is much higher. It's about 68, but same thing. We've got plenty of cash positions. I'm not just trading for trading's sake. If it's not the right environment for that strategy, go ahead and sit in cash. Absolutely nothing wrong with that. And the last one here, have the ability to move to safety quickly. Now for that one, this will of course depend on your situation. But what I mean by that last one is You don't want to put yourself in a situation where you're getting into trades that can move quite quickly, right? Volatility ETPs or option trading, and have your personal situation be that you can't exit those trades quickly. Maybe it's for tax reasons. Maybe it's the structure of your account. Maybe the broker you trade at doesn't allow you to cycle through trades that quickly. Maybe you partially have a position in the financial industry and you're regulated against cycling through trades, or whatever the case may be. If you're in a position where you can't exit your risky positions almost immediately, then don't put them on. Or at least make sure they're extremely hedged ahead of time. Because the last thing you want to do is wake up one day, get hit by a vol-apocalypse event, and then have your account structure or the way that you've set up your portfolio that you can't exit. You just have to sit there and watch it happen. So that's that last little bit. For me personally, I can cycle out of every position I have on a one-day notice. So it does allow for a little bit more nimbleness there when we're facing extreme events like that. So keep those 4 things in mind. If you do stick with these, I think you're probably going to be okay. As long as you trade the right products, you're not using undefined options, you're only trading a smaller portion of your portfolio, you're only allocating capital when you really do see those good opportunities where your strategy can take advantage of, and if necessary, you can cycle out very quickly. If you're sticking to this, I think you're probably going to be okay. Obviously, I've been trading volatility for 15 years. I'm not here to dissuade anybody and to say that it's too risky, don't even bother. I do it. I've been doing it heavily, and it's a major portion of my portfolio. But that doesn't mean that we don't always have to be mindful of the risk factor here. And there is risk. There is unknown risk. I'm very good at getting out of positions before they get out of control, and I've never suffered a drawdown. But I'm allocated to a position right now, short volatility. What happens if I wake up tomorrow and, God forbid, there was a terrorist attack? I don't know what's going to happen tomorrow, so I have to make sure that the position size is small, that, I'm going to take a big hit tomorrow, but I can get out of that position on the very next day, things like that. We have to have layers of protection because none of us can fully guarantee that we can navigate this volatility space safely. And another thing that I would say is oftentimes on Twitter, I see people talking about how they can just exit their positions if things start to go badly. They can manage their trades or they can defend the position if they have to. Anybody who's saying that probably doesn't have any experience with a fast-moving market. And if you're even the slightest bit superstitious, trust me, the market gods that are watching over all of us, they've prepared lightning bolts to throw at anybody who says that you can manage your risk during the crisis. Doesn't work that way. Risk comes quick, especially in this volatility space, and there's no way that you can defend the position while it's happening. Once it starts, you better just hope that you had that list of things in place beforehand, because very little you can do in the moment. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.